What if I told you that for decades, some of our sharpest economic models were getting a really fundamental question completely wrong? We're talking about a question right at the heart of how we manage the economy. What actually happens when a central bank steps in to cool things down? Well, this is the story of a deep economic mystery and the incredible 2005 paper by Bernanke, Boivin, and Eliasz that finally cracked the case.
It seems like a pretty straightforward question, right? When the economy is running hot and prices are climbing, the central bank raises interest rates. It's like tapping the brakes. So logically, prices should come down or at least stop going up so fast. I mean, that's pretty much Econ 101, and this is a huge but, for years, our most advanced economic models were showing the exact opposite. Just take a look at this chart right here. This is what those older models were predicting what happened to inflation, the CPI, after the central bank hiked rates. See that dotted line? Instead of heading down, it actually goes up. And this wasn't some random glitch. Nope, it was a consistent, totally baffling result that got a name, the price puzzle. And look, this wasn't just some headache for academics. This was a really big deal. It suggested that either our basic understanding of economics was way off, or the very tools we were using to guide these massive multi-trillion-dollar economies were fundamentally broken. So these standard models, they're called vector autoregressions, or VARs for short, and they kept spitting out this bizarre result. Just try to imagine you're a policymaker steering the economy, but every time you check your GPS, it tells you that turning left makes the car go right. It's nuts. That was the kind of problem economists were staring down.
So what on earth was going on? Well, the leading theory was that the models had a massive blind spot. They just couldn't see the full picture that the central bank was looking at.
And this slide just lays it out perfectly. A standard VAR model might look at, say, 6 to 8 key data points, things like GDP, inflation, and interest rate. But in the real world, the Federal Reserve is tracking hundreds of different data series. So think about it. The Fed sees some early warning signs of inflation in all that data and raises rates to get ahead of it. The little model, which can't see those warning signs, only sees two things, the rate hike and then the inflation that shows up later anyway. So the model makes a mistake. It thinks the rate hike caused the inflation, when really it was a reaction to information the model didn't have. And the authors themselves put it perfectly in the paper. These models were just information poor. They were trying to understand a super complex, high-information decision using a low-information toolkit. They needed a way to give the model the same kind of panoramic view that the central bank has.
And that is what brings us to their absolutely brilliant solution. They didn't just add a few more variables to the mix. No, they came up with a whole new technique to basically give the model a massive vision upgrade.
They called it the Factor-Augmented Vector Autoregression, or FAVAR. Honestly, the best way to think about it is like this. It's like going from trying to diagnose a patient with just a thermometer to using a full-body, high-resolution X-ray. The FAVAR takes hundreds of economic vital signs and boils them down into a few clear summary images, these factors that show you what's really going on under the hood of the economy.
So how does this thing actually work? Well, first you feed it a mountain of data. In their case, 120 different economic reports every single month. Then, it does some statistical magic to find the big underlying trends in all that noise, things it might label economic activity or price pressures. And finally, you take these super powerful new factors and you augment the old simple model with them. The result? You get a model that can finally see the economy with the kind of clarity a real central banker has. All right, so the big question, did it work? Did this economic X-ray finally solve that pesky price puzzle and give us a true picture of what monetary policy does? Oh yeah, the results were absolutely dramatic. Okay, so check this out. On the left, that's the old, confusing result. See the dotted line for CPI going up? Now look at the right. These are the results from the new FAVAR model. Look at the CPI chart after the policy shock. Prices fall, exactly like the textbooks say they should. The price puzzle was solved, just like that. But what's even cooler is that for the first time we could actually trace the true ripple effect of one policy decision across the entire economy, from factory output all the way to unemployment. And we can even put some real numbers to that ripple effect. This table shows how much of the normal monthly bouncing around in these economic indicators is actually explained by a surprise move from the Fed. For unemployment, it's over 10%. It's a small slice of the pie, but it's a real, significant, and now finally a measurable impact. And to make that even more concrete, the model shows that a surprise rate hike leads to a dip in industrial production of about 0.5%. That's a real tangible effect on how much stuff our country is actually making. And on the other side of the coin, that same move causes the unemployment rate to tick up by about 0.15 percentage points. You see, these aren't just lines on a graph anymore. They represent real-world impacts on businesses and jobs, and now we can actually see them clearly.
So why are we talking about this? Why does solving some academic puzzle from back in 2005 still matter so much today? Well, because it goes to the very foundation of how we make these huge economic decisions.
At the end of the day, the big takeaway is this. The FAVAR approach wasn't just about fixing one little puzzle. It was a total game changer. It proved that if we harness the power of big data, we can build models that see the economy for what it is, a super complex, interconnected system. And that, of course, leads to smarter policy for all of us.
And that kind of leaves us with one last really important question to chew on. The price puzzle showed us a huge blind spot in the economic models of that time. So it really makes you wonder, with our economy changing so fast, with all these new kinds of data popping up, what are the critical blind spots we have right now? What are the puzzles that we don't even know are puzzles yet?